So one of the things that obviously, when we're talking about our preliminary third quarter 2015, we know that there was a lot of changes just yesterday. We saw the Nasdaq drop about 1.5% in one day. So some of the numbers are going to be off, but we think the trends and analysis we're going to provide are going to be strong enough for you guys to work from and actually get a glimpse on what's going on. So let's go ahead and take a look at what I normally do, and that's basically looking at the third quarter at a glance. And when I'm taking a look at these, basically there's three things that pop out here. China region, growth concerns are obviously a problem. Fed interest rate increases certainly are a fear. We've had some, fairly good employment figures come out. Certainly, yeah, I'm going to say, better than expected economic numbers come out, and that puts the fear that the interest rates are going to rise here soon. We know it didn't happen in September, but also the other issue that we see out here is that we're taking a look at commodity prices just getting crushed. So we take a look at July. We had kind of a poor showing, a 0.07% return with almost nothing as far as losses go, but 68% of the funds were actually in positive territory. And that's one of the things that, when we're paying attention to kind of the three issues that I was talking to you about, really what sticks out here is China getting crushed in both July and in August. Basically, I have up here that China had its worst performance that it had since for at least 4 years. But they did take back some of the losses. There were some good things happening in July. They lost a lot, but then when they finished up the month, they suffered their worst loss since August 2009, and that certainly was part of the story. But really, another part of the story that we see driving these numbers are oil was down 20.77% for the month alone in July, and gold was down 6.54%. So while we saw this kind of increase in volatility and didn't know where things were pointing towards, we did see investors actually looking for opportunities to buy into, and certainly was growth getting away from value as we see throughout the same thing. So if we take a look at August, though, equity funds were down 5.37%, and certainly that was a concern. Volatility was on a rise. We saw the VIX hit its highest point in 7 years. Certainly the numbers stayed high for mid portion of the month, and a lot of news came out. For instance, China basically saw factory activity drop to a 6.5-year low, and that put more pressure on it. So while we have good numbers come in, even our employment numbers did not look all that bad in August. We saw the economy added about 215,000 jobs for July, and that was the news that we had, and that certainly provided fodder for the Federal Reserve to raise interest rates. And that's always been the same. So we're talking about slowing global growth, but then we turn around and see fair numbers coming in from the Fed, and the Fed rhetoric has been towards basically the hawkish stance and raising interest rates, but it certainly has been kind of that weighing of both issues. That takes us into September, and again, this is only through the 17th of September, but certainly global markets appear to be on the mend. We saw unemployment rate come in a little bit lower than I was expecting. 133,000 jobs were added when we thought there was going to be about 217 by analysts' expectations. But the unemployment rate dropped to 5.1%. It's the lowest we've seen since April 2008. And again, it certainly gave people the idea that we have some reason to think that the economy's tooling around, and the Fed certainly is going to raise interest rates. At the end, when we saw the FOMC meeting come in, and we saw that the global headwind comment by Janet Yellen, put a little bit of I'm going to say fear in the markets. Basically, there's this question of, is the economy worse than we think it is? And that has certainly set the last couple of days on fire as far as markets turning down. At the top of the run, though, here for September, we saw healthcare, health biotechnology funds taking return 4.17%, global health 2.76%, and then we saw real estate funds up 2.75%. That was kind of bottom shopping. But the healthcare issue, we saw Eli Whitney come out with a new drug, and they said some promising trials. That was good until presidential hopeful Hillary Clinton came out and said, listen, I'm going to put a cap on drug money. So that's why we've seen some of this kind of meltdown the last couple of days. So some of these numbers are going to be a little bit weak. Overall, we were, as everybody knows, in correction territory. So risk aversion was kind of the name of the game. Large caps were in favor, and it was just kind of a weird market. Let's go ahead and take a look at the preliminary Q3 numbers. It's the first quarterly loss in four. After being the darling over the last several quarters, world equity funds were the solid dwellers. Shanghai Composite was down 29.72%. Big losses there. When we're taking a look at the overall numbers, again, the decline was 5.17% for equity funds overall. At the top of the universe, mixed asset funds did a better job mitigating losses than did their USD, sector equity, and world equity counterparts, with world equity funds, again, down 7.39%, just getting crushed. If we take a look at the total numbers, we saw that 4 of 96 equity classifications actually had positive returns, so only 4. That's a huge number for as far as downside performance goes. And dedicated short bias, as we would probably expect, is at the top, 7.68% for the quarter. And then we had the commodity specialty group. That is also a short biased group. They were betting against oil and gas and the like, so natural resources in general in the commodity sector, and they were up 3.56%. As I told you, last quarter's laggard real estate funds certainly had some buying opportunity there just because of how bad they got beat last quarter. They only gained about 1.77% for the quarter. Now, one thing we did see is that the dollar did weaken slightly, but again, overall, when we're taking a look at those numbers, even though the dollar weakened slightly, it's up quite a bit for the year, and certainly that's a concern for earnings coming forward. We'll talk more about that later. One point, again, wanted to point out, gold lost about 4.63% of its value, while oil shed about 21.14% of its value over the quarter, and that's certainly a story to keep an eye on, and it'll resonate through the entire presentation. So we take a look at the United States Diversified Equity Fund Group, the second best performer for the quarter and the best performer in September. The top and the bottom certainly is not a feat of imagination at all. We saw dedicated short bias funds doing very well, 7.68%, and diversified leverage funds at the bottom, getting crushed because of what the market did. So both of those certainly make sense. For the first quarter in 9, though, diversified leverage funds lost the largest amount of this group, down 13.73%. If we take a look at September, really, growth is back. Small cap growth did better, 2.65%. Multi-cap growth up 2.04%. But when we take a look at the laggards, as we'd expect, when the market starts getting a little bit better, remember it's up 1.1% to the 17th. I know that I just ran the numbers this morning. They would be down for the time period if I ended it as of yesterday. But year to date, by the way, we're down only 1.4%. So all this talk about a 10% correction from the market high, certainly we have to put that in perspective. Year to date, the group's only down 1.40%. Taking a look at this and kind of highlighting the area, I told you, growth is kind of in favor, and value-oriented funds, and of course the equity leverage, the diversified leverage group, is at the bottom. Certainly value has come under attack a little bit. I think people are concerned that some of the interest income coming out of the value plays may be of question, and certainly we've seen that from other yield-producing securities as well. That the fear of Fed fund rate increases was certainly right there. I think the equity markets kind of bet against it, while the fixed income markets bet that we would have a raise, and we see this in this particular slide as well. When we're taking a look at the 4x3 matrices for Q3 preliminary performance, we see that for the first quarter in 4, large cap funds mitigated losses or outperformed their other capitalization groups, declining to only 3.33%, while small cap group was down 5.28%. And for the 5th consecutive quarter, growth-oriented funds either mitigated losses or outperformed the other valuation groups as well. So that was part of the story. According to Lipper Active Indices, the large cap growth funds benefited from strong weightings and relatively good performance in this consumer discretionary group as well. And so we can do a deeper dive by taking a look at portfolio holdings and see. That's one of the reasons large cap growth did a better job mitigating losses. If we take a look at the 1 month return pattern, and we actually see some green and yellow here, so we know that we had some positive returns. For the first month in 3, basically we saw small cap funds do better, 1.56% positive return, and for the 4th month in 5, we saw that growth-oriented funds were able to outperform as well, with small cap growth funds returning 2.65% and being helped significantly by healthcare, information technology, and industrial sectors. Take a look at the sector equity funds group. The quarter was the 3rd best performing group. and basically it was the worst for monthly performance. And this is really kind of all dependent on, well, two things. Some of the better performance was actually the healthcare issue I was telling you about earlier, but until Clinton made comments. But certainly this is an oil and gold issue. Obviously we've had some strong news that OPEC, for instance, was not willing to support Saudi was not willing to support the OPEC emergency meeting. That we've had a glut in supply and a decrease in demand, and certainly that's played heavily on gold prices and knocked it down quite a bit. And also with gold, again, people have just been kind of bailing on the yellow metal for quite some time. And so when we take a look at the bottom performers for the quarter, we have a commodity, CME is commodity energy funds, down 17.49%, gold down 16.51%, and energy master limited partnerships basically were down 16.01%. A lot of people said, "Oh, that's because we've seen a decline in the prices of oil and gas," and that's not necessarily the fact. It really has to do with the volume going through the pumps and through the pipes and the like, and so that's impacted it. And also, energy master limited partnerships were used as an income play, and I think a lot of people walked away from some income products after bidding them up for quite some time, and so that's part of that story. Again, we take a look at September, health biotechnology, general global health biotechnology top performers, and then we have specialty miscellaneous and energy at the bottom with energy MLPs probably taking the worst black eye of the group for the monthly period. Year to date, worst performing group, 6.36% in the negative. So taking a look at this again, remember I was just saying it's commodities, basic materials, natural resources, energy master limited partnerships, MLPs, precious metal funds, and commodity funds all at the bottom. And if you see, basically there's that demarcation right around the 10% mark. After you get in there, you get in global financial services and some of the other commodity areas, but they did not lose as much significance as some of these bigger commodity plays. Take a look at the world equity funds. Basically, the story is China and slowing global growth. I mean, we've had this issue come up. It's really a recent phenomenon. If we take a look, basically, at world equity funds, they were top performers in prior quarters. So this is something that's kind of changed the game, so to speak. It's the worst performing, obviously, down 7.39%. European region funds was able to mitigate losses better than anybody else in the group. But if you had anything to do with China, global growth, emerging markets, you pretty much got crushed. Again, China is down 19.15%. It was Q2's leader. Latin America got crushed, down 16.38%. Obviously, some of that has to do with the oil and gas prices, but also the participation in providing materials to China. And then, of course, emerging markets got hurt quite bad as well. The same thing basically kind of runs through when we take a look at the month. China region funds did a little bit better. Remember I told you the global economy appeared to be on the mend. Again, this is up until the last couple days. So we had global large cap growth funds up 1.63%, global multi-cap growth funds up 1.34%. So there's that growth story I was telling you about originally. But certainly, again, if I change the numbers random again this morning, that changes a wee bit. Year to date, only down 3.01%. So for all the carnage we've seen, again, only down 3.01%. All right, so taking a look at the 4x3 matrices, 3x3 matrices in this case, basically we take a look and we see that the international group actually strayed away from a little bit from what the USDE funds did. We had international diversified equity funds favor small and mid-cap funds, while USDE was actually up to the large cap. But in both of these groups that we're taking a look at, international and global, growth was a predominant factor as far as mitigating losses. Again, when we look at these, it's not a big difference. It's kind of ho-hum and down for all those groups. But when we take a look at the global side, it kind of feathers well into the United States diversified equity story. Large caps did a better job mitigating than the small and mid caps did. Taking a look at this piece, again, this is where if you had any relationship, any strong ties with China, emerging market funds, you probably took it on the chin here. The declines were way above 10%, and of course, the worst being China, getting up in the 19% decline rate. So we take a look at the preliminary numbers for mixed asset funds. It's kind of always something I like to bring up. This is the first quarter in 5. that they were the top performers, and they have done a fair job mitigating losses when compared to the other groups. But again, we're only talking about 2 percentage points difference between the USD funds and the mixed asset funds as well. I mean, they're down 3.13% for preliminary third quarter. September, they actually up 0.49%. Year to date, down 1.84%. We have the top alternative multi-strategy funds, 1.43%. And they were the group that mitigated losses best. And then, of course, as we expect, mixed asset target allocation growth funds were down 4.52%. That's probably the most aggressive of the group. One thing I wanted to also point out, and the reason I bring this up quite frequently, is for the very simple reason that I like to point out that mixed asset funds have been the big attractor of assets over the last several years. They were only surpassed recently over the last several quarters by world equity funds. So here's what's happened year to date to August 31st. Basically, United States diversified equity funds are now down $92.4 billion. They've actually seen net redemptions of $92.4 billion. Sector equity funds have taken in about 10.9. World equity funds have taken in 98. Again, that's something new. It's a thing that's been happening just this year, surpassing mixed asset funds. Mixed asset funds have taken in 49.3. So of the $52.8 billion net new money year to date coming into the equity fund business, basically we're seeing the world equity funds and mixed asset funds account for all of it. And certainly that has been a story as well. Well, let's go ahead and get to kind of the end of this presentation and what I see as some of the issues that are out there. Obviously, China uncertainty is out there. We heard this morning that the manufacturing output is at a 6.5-year low. Again, as kind of preliminaries coming out, certainly that brings some concerns around. The U.S. dollar is still pretty high, and so it could impact the multinationals' bottom line when we take a look at the earnings reports. But one thing I wanted to talk to, and I'm going to jump right to the bottom of why I think things are positive. We had a kind of better pre-announcements period so far. While we've had 93 negative announcements for Q3 compared to 29 positive, is a complete improvement from last quarter. So it's lower than Q3, and it's improvement from Q2 2015. So Q3 2014 last year versus this year, definite improvement is 4.0. This one comes in 3 and some change. I believe it's 3.2. But if we take a look at the last month and the month and the year ago, we're talking about 4.3. So this is quite an improvement as far as pre-announcements go. And then also, consumer sentiment did somewhat better. I'm not a real big fan of using consumer sentiment, but I'm sorry, consumer sentiment was worse. I'm sorry, when we're taking a look at some of my concerns. But I'm not a big fan of using consumer sentiment, even though it's at its lowest since 2014. That thing flips quite a bit. I guess one of my biggest concerns, and everybody's out there, is commodity prices. Will they continue on the decline? So that is it for me, and I'm going to go ahead and hand off to Jeff. And by the way, if you do have any questions, please ask. If it's germane to the particular slide or the presenter wants to answer, they'll answer right then. If not, we'll save them up and give you a chance to do Q&A at the end of the presentation as well.